Tokenized money market funds, Goldman Sachs and BNY Revolutionize finance. Imagine a financial world that never sleeps, where your investments settle instantly and markets hum along 24/7. That's the exciting promise of tokenized money market funds, and it's being driven by heavyweights like Goldman Sachs and BNY. These Wall Street titans are teaming up to give institutional investors a cutting-edge way to manage cash, leveraging blockchain technology to boost efficiency and open up new possibilities in capital markets. To break it down for anyone new to this, a money market fund is essentially a low-risk investment vehicle that pools money into safe assets like government bonds or short-term securities. What makes this version special is tokenization. It uses a blockchain. Think of it as a super-secure, digital ledger that records transactions transparently, to represent ownership. In this case, BNY clients will soon be able to buy into these funds, with their stakes tracked directly on Goldman Sachs' private blockchain. This setup allows for real-time settlements, meaning trades clear almost instantly instead of waiting days, and it enables 24/7 access, so investors aren't tied to traditional market hours. As Lade Majagby, BNY's global head of liquidity, financing, and collateral, puts it, this is all about ushering in a more digital and real-time financial landscape. And it's not just a two-player game. This initiative ropes in major players like BlackRock, Fidelity Investments, and Federated Hermes, along with the asset management divisions of Goldman and BNY themselves. For example, BlackRock has been experimenting with similar tech in their tokenized treasury funds, showing how this could seamlessly connect traditional finance with digital innovations. But here's where it gets controversial. This development is happening right on the heels of the Genius Act, a new U.S. law that creates rules for stablecoins and outright bans those that pay interest. While that might sound like a setback for digital currencies, it could actually supercharge the appeal of tokenized money market funds. Unlike banned interest-bearing stablecoins, these funds still offer yields. Basically, you earn returns on your investment, making them a smart choice for hedge funds, pension plans, and corporations looking to park idle cash with minimal risk. For instance, if you're a company with extra funds sitting around, this could be like having a high-yield savings account that's always accessible and less volatile than crypto. And this is the part most people miss. The rapid growth of these tokenized funds isn't just a fad. According to a recent Moody's report, assets in tokenized short-term funds have skyrocketed to $5.7 billion since 2021, drawing in traditional asset managers, insurers, and brokerages. These funds are typically backed by ultra-safe instruments like U.S. Treasuries, but the blockchain twist allows for fractional shares, so you could invest small amounts that weren't possible before, and instant settlements that cut out middlemen and reduce errors. It's like upgrading from a clunky old car to a sleek electric vehicle, same destination, but a smoother, faster ride. The race to digitize capital markets is intensifying, with moves like Robinhood's announcement of Robinhood Chain, an Ethereum-based Layer 2 network built on Arbitrum Orbit. This would let users trade tokenized versions of stocks directly on the blockchain, bypassing the usual exchange restrictions and enabling trading at any time. Galaxy Digital's analysis adds fuel to the fire, arguing that this shift could siphon liquidity away from established players like the NYSE, potentially disrupting the concentrated power that makes traditional markets tick. But is this a genuine step toward a more democratic financial system, or could it introduce new risks, like increased volatility or regulatory headaches? What do you think? Could tokenization be the key to unlocking a more efficient future, or are we overlooking potential downsides that could come back to bite us? I'd love to hear your thoughts in the comments. Are you excited about this or skeptical? Let's dive into the debate. Goldman Sachs and BNY. Revolutionizing the $7.1 trillion money market with digital tokens. In a groundbreaking move, Goldman Sachs and Bank of New York Mellon have joined hands to revolutionize the colossal $7.1 trillion money market industry through the innovative use of digital tokens. This bold step marks a significant shift in the financial landscape, promising to reshape how institutional investors manage their cash holdings. Imagine a world where your money market investments are as fluid and accessible as digital currency, yet offer the security and yield of traditional funds. That's exactly what these Wall Street titans are aiming to achieve by enabling institutional investors to purchase tokenized money market funds. BNY Mellon, the world's largest custody bank, will facilitate investments in these funds, with ownership meticulously recorded on Goldman's blockchain platform. Industry giants such as BlackRock, Fidelity Investments, and Federated Hermes, along with the asset management divisions of Goldman and BNY, have already pledged their support for this pioneering project. The tokenization of the money market industry follows closely on the heels of President Donald Trump's signing of a law that ushers in U.S.-regulated stablecoins, a move that is anticipated to spur the widespread adoption of stablecoins, typically pegged to the U.S. dollar. Unlike stablecoins, however, tokenized money market funds offer the allure of a yield, making them an enticing option for hedge funds, pension funds, and corporations seeking a secure parking spot for their cash. According to Lade Magiagbe, BNY's global head of liquidity, financing, and collateral, the step of tokenizing is crucial as it paves the way for seamless and efficient transactions, eliminating the bottlenecks often encountered in conventional markets. Money market funds, traditionally invested in safe, short-term securities such as treasuries, repo agreements, or commercial paper, are seen as the closest investment alternative to cash that still yields returns. These funds can usually be liquidated within a couple of days, although redemptions are limited to market hours. In recent years, both institutional and retail investors have flocked to money market funds, injecting approximately $2.5 trillion since the Federal Reserve embarked on a rate-hiking cycle in 2022. By creating digital certificates of ownership for these funds on a blockchain, Goldman and BNY aim to expedite settlement times, enable around-the-clock trading, and automate processes. To ensure a smooth transition, BNY will maintain traditional money market records alongside the digital tokens. The banks envision tokenized funds as the cornerstone of a future financial ecosystem characterized by enhanced efficiency and constant digital availability. Stablecoins could serve as a medium for global payments, while tokenized money market funds could be used for cash management. Moreover, tokenizing the asset class could unlock new capabilities, allowing for the direct transfer of funds between financial intermediaries without the need for prior liquidation into cash. This development could significantly enhance the utility of tokenized money market funds as collateral for various trades and margin requirements, according to Matthew McDermott, Goldman's global head of digital assets. It promises to streamline transactions, freeing up time and capital currently tied up in traditional processes. Instead of selling money market funds to provide cash collateral for a trade, investors and corporations could simply exchange the token. McDermott highlights the transformative potential of this innovation. The sheer magnitude of this market presents a tremendous opportunity to enhance efficiency across the entire financial infrastructure. What's truly revolutionary is that we're introducing utility to an instrument where it was previously non-existent. BNY Mellon and Goldman Sachs Tokenize money market funds. Future of digital collateral. Imagine a future where money market funds, the typically straightforward investment vehicles, are transformed by the cutting-edge power of blockchain technology. This is exactly what the Bank of New York Mellon, BNY Mellon, and Goldman Sachs are pioneering together by introducing tokenization to money market funds, MFs. But here's where it gets controversial. While tokenization often targets crypto communities, this initiative is laser-focused on institutional investors, potentially reshaping how traditional finance operates behind the scenes. The collaboration enables investors to subscribe to MF shares through BNY Mellon's Liquidity Direct platform, with ownership digitally represented as tokens on BNY's Digital Assets platform. These tokens are mirrored on Goldman Sachs' GS Digital Asset Platform, GSDAP, which is built on blockchain technology. Alongside them, heavyweights like BlackRock, Fidelity Investments, Federated Hermes, BNY Investments Dreyfus, and Goldman Sachs Asset Management are backing the launch, adding significant institutional weight. At first glance, this might seem like a simple subscription and redemption system, but the ambitions run much deeper. The ultimate aim is what's called collateral mobility. Tokenizing MMFs means these funds can be instantly transferred and used as collateral, for margin requirements or other financial uses, without the delays and complexities of traditional systems. This could revolutionize liquidity and operational efficiency in institutional finance. Our financial ecosystem is evolving to embrace digital, real-time infrastructures, says Lade Magyagbe, Global Head of Liquidity, Financing and Collateral at BNY Mellon. Mirrored tokenization of MF shares marks a critical initial step toward this future. It's important to note that BNY Mellon will still maintain official books and records for the funds, ensuring trusted oversight amid this innovation. Goldman Sachs' Matthew McDermott, Global Head of Digital Assets, adds, representing money market fund shares as tokens on GSDAP frees us to unlock their full utility as collateral, paving the way for smoother and faster transfers down the line. So, what lies ahead? Currently, this initiative is taking place on a private, permissioned blockchain called GSDAP, which uses digital assets Canton blockchain technology. However, there are hints that future phases may venture onto permissionless blockchain networks, those more commonly seen in the crypto world, which allow broader access and decentralization. This could spark debates about security, control, and regulatory compliance, as institutions balance innovation with risk. Interestingly, GSDAP sits alongside the Canton network, a more open and permissionless blockchain where Goldman Sachs holds a governance role. While the Canton network is still evolving toward full decentralization, it already represents a compromise by combining institutional oversight with the open access ideals of blockchain, aiming to bridge the gap between traditional finance and crypto's transparency. This project is far from alone. The landscape is crowded with several ambitious institutional tokenized collateral efforts. Digital Asset is advancing its tokenized collateral networks with multiple crypto market makers. The DTCC, Depository Trust and Clearing Corporation, plans its own tokenized collateral platform. IC, Intercontinental Exchange, executives have shared optimistic views on stablecoins and tokenized collateral. And the CME Group is experimenting with Google's new Universal Ledger technology to trial tokenization. Is this tokenization wave the future of institutional finance, or just a fad riding the crypto hype? Could permissionless blockchains replace traditional permission networks, or is the cautious middle ground offered by projects like Canton Network the real winner? We'd love to hear your thoughts. Do you see tokenized money market funds as a game changer or a risky gamble? Join the conversation below and share your perspective.